Hello, everybody. Thank you for joining us on this beautiful Friday morning. Welcome to the bonus session with Spero's very own Stephen Wemple. He is the associate at Spero right now, or one of the associates at Spero right now, and he so kindly offered to do a wonderful session for us today on financial modeling and kind of, as you go and you think about your journey as a founder and some of you are just getting started, some of you already have a little bit of money like that's flowed in, but ultimately we're here to start a business, right? And we're here to make a long lasting, impactful and hopefully billion-dollar business. But to do that, you need to understand your cash flows and your projections and what are we as investors looking for. When you come into our office, saying I need $1 million, what are we looking for from you? And what will get us excited to invest in not only you as a person, but you as a business. So without further ado, I'll pass the mic off to Stephen to further introduce himself and to dig in.
Awesome, Brandon. That was a perfect tee up to the session. And I think on top of that, one thing I'm aiming to do here is to dispel a few myths about the financial model and hopefully make the model itself and the exercise that is, I think, very valuable, a bit more approachable. I think a lot of people get petrified when they get in front of an empty Excel spreadsheet or Google Sheet and don't know where to start. And hopefully this will aim to kind of take it to the high level and talk about kind of why it matters, how we use it, what's the point, and then work through kind of how to get started and make it a bit more approachable. But before we jump in, just real quick, for those of you who are joining for the first time or this is your first introduction to Spero, I'd love to just run through who we are as a firm. So we are an early stage venture fund investing in founders that are building the things that make life worth living. And it's our fundamental belief that the best companies of any generation are ones that are purpose driven and will produce outsized returns both for society and for the stakeholders involved, including the founders, investors, and employees. We have a single LP model with a value-aligned LP or investor, Pierre Midyar, who is the founder of eBay. He very much believes in kind of our vision and mission in backing founders that kind of have a big long-term mission that are solving real problems for people and for society. And our team is comprised of a bunch of former founders and operators that we think really capture kind of the founder spirit and journey. Reminder, would love for you to share your key takeaways and learnings out on social. You can tag us at Spero Ventures and myself at Wemple_Stephen. Definitely want to see you on Twitter and getting this content out. Really appreciate that. All right, so again, high level goals here, dispel a few myths about the model, kind of make it a bit more approachable and hopefully give you a place to start. And then also dig into kind of what investors are looking for, what we care about, why it matters to you, and we'll go from there. And then of course, we'll open up for Q&A at the end. I'm hoping this presentation's between 25 and 30 minutes, and then we can discuss there. And then I will just start with a caveat here that every financial model is different for every company. So I'm going to hopefully give you kind of like the mental models, the frameworks that you can use to then apply to your business specifically. It's far more of a creative exercise than I think people might think on the surface, particularly at the seed stage when there's so many questions remaining about the business model, the go-to-market, acquisition, and all these other things. So take what I say with a grain of salt. This is just one additional data point as you all explore kind of building your models and the purpose of the model. And I'm speaking for myself here. I'm not speaking for all investors out there. So again, this is just one additional data point and hopefully can serve as a resource for you all as you continue your journey as a seed stage founder. So real quick, high level, what is a model? It's a forward-looking tool, and I put a lot of emphasis in this presentation on this word tool because I think it's a valuable tool. So it's a forward-looking tool that illustrates a company's financial projections, the key variables, and the company's business model. So this is kind of a patchwork definition that I put together, but I think kind of particularly for a seed stage founder thinking about a model is how you can think about it, right? It's an illustration. It's of, how you see the company growing. What are the key inputs or variables that drive the business? And how does the business model actually work? What are the fundamentals of the way you make money? Where are you spending money? How are you acquiring users? And what is not a model? So when I, as an investor, or we at Spero ask for you to share a model, if we do, what are we not expecting to see? We're not expecting to see historical data. If we want to see historicals, which we likely will, we'll ask for historicals. But if someone asks you for a model, don't share backwards looking material, right? Don't share your trailing 12 months. Now, many times people will have their historical data in the same place as their model, and that's great. It's wonderful for context, but don't just share backwards looking things. Emphasis on how you see the company going forward. And then KPI and metrics dashboards. So again, also something we'll probably ask for, but if we ask for a model, we're not asking for some dashboard that shows, MRR or, what you might use kind of internally as your operating KPI check-in place. While again, you might have that in your model, it might be a tab in your model or might live alongside your model. We're not looking for that specifically when we ask for a model. We're asking for some sort of forward-looking model that is typically, 24 months of data on a monthly basis, and then 5 years of projections. That's kind of the typical status quo of what we're asking for. So 24 months in the future, and then additional 3 years on top of that. So do I really need a model at the seed stage? I get this question a lot, and I think the answer is no. Honestly, you don't. But I think it is an incredibly valuable resource for you as a founder internally, first and foremost. And it's also will serve as a really great tool to share your story and validate some and flesh out your business with investors. And we'll talk a little bit more about that. But I want to just stop here and say, if a seed stage investor is is digging in really deeply into your model and pushing you on a lot of unknowns about your business model or about your projections and wants to get granular on your projections, I would actually think that that's a bit of a red flag. It's not the case for every investor. They might have some reason behind it, but I would ask, at the end of the day, what you're doing as a seed stage investor is you're selling a mission or a vision. You're selling some wedge into a large market, and you're selling yourself. The model is a tool to validate one of those three things, right? If you feel like you're a first-time founder and you need to de-risk yourself, a model can be a great tool to validate yourself, to de-risk yourself, right? It can be a great way to de-risk kind of the market, right? If you say, if you can map your model to a market, right? So investors, particularly at the seed stage, should not be making a decision on your forward-looking projections, because at the end of the day, what you put together here is, I almost would say 99% going to be wrong, right? Your business will change, your business model will change, the fundamentals, the variables will all change. What we want to see is that you're thinking through the fundamentals of your business, and that it's viable given the information and the ideas and the thoughts and the forward-looking imagination that you have. So we won't spend too much time on that, but just don't put. We'll stop there and say also, like, don't put a ton of pressure on this, right? It's just an additional tool in the toolbox. So what purpose does it serve? If you're telling me that it's not important, if no one's going to make a decision on it, what is the point of it? Why are we even doing this? Why do we even ask? Well, I think first and foremost, the financial model is a tool for you, and it does a few things. It helps you understand your business model. I think a lot of founders, and rightly so, come to a business with with an idea, a problem they want to solve. But the reality is, for a business to solve a problem, it needs to have fuel, and fuel is cash, it's revenue, it's the business, right? So you need to be able to prove, or you need to stress test, or you need to validate that there is a way for this business to actually exist. Can you make more money than you burn, or can you raise money to make revenue and then burn cash, right? you need to validate that this is feasible to do in order to solve the problem and in order to continue solving the problem over time and at scale. It's a tool to help you understand the resources you're going to need to grow, right? So if you're going to model out what it's going to take to get to XYZ point in the future, hopefully the model also tells you how many people you'll need to hire, how much capital you'll need to raise, how many marketing dollars you'll have to spend in a given year to acquire this many users, right? So it'll give you, or how many engineers are you going to need based off of your assumptions that you make, right? So it's a tool to help you, again, understand, how many resources you need. Oops. It's a way to tell your story. So I different investors are think differently, but I really find it, one of the things I look forward to most is just jumping into a founder's model, because it's really fun to see how the story that they're telling about their growth maps to kind of what it looks like in an Excel spreadsheet, right? Everyone's kind of a different kind of learner, visual, auditory, all that kind of stuff. I think a handful of investors will be kind of interested in seeing that fundamentally in a spreadsheet, because that's just sometimes where we live and sometimes how we think, right? So it is a way for you to tell your story to a different audience, right? It's a way for you to map the narrative you're telling, your pitch, and map it with numbers. And it's an opportunity to instill confidence, right? I said, at the seed stage, you're selling a mission, a vision of the future, a wedge into a big market, and yourself. And a model can be a way to validate a few things, right? That you've thought about the market, that that you can see how the market's going to evolve, how your business is going to evolve, and that you fundamentally understand kind of how these businesses in your given sector or vertical work. So it's an opportunity to instill confidence. Okay, and so what does the purpose serve? What is the purpose for investors? So, it maps a lot to how it's a tool for you, but, it's a complementary piece of collateral that maps to the narrative or pitch, right? So if you're telling me something about how you see the company evolving, and then the numbers or the business model or the way you're talking about it don't map to what you're sharing with us, that's a bit of an area of concern. It just leaves room for questions to be asked, right? So if you're telling me you're going to grow this way, mostly through, outside sales, but your marketing is 60% of your revenue, then in your projections, then we'll want to understand why. Or if you only have a minimal amount of engineering spend, but you're building a really technical product, we'll have concern. Or if your personnel spend is really, really high, we'll want to understand what validates it. So just making sure that it maps to the story that you're telling us. A lot about, for me, again, I think seeing a model really helps me visualize or understand the business a bit more, right? It helps me understand kind of the key drivers, the inputs, the outputs, what are the core questions we need to be asking, and what are the things that are going to move this business, and then how can we kind of validate that in our diligence. I think a lot of investors, particularly at the later stage, or maybe even more at the Series A specifically, use the model as a way to kind of vet a founder's understanding of business fundamentals and industry standards, right? So if you're a SaaS company, there's so much public data about, how much an efficient SaaS company can expect to spend on, every line item on a spreadsheet or in a model. There's very obvious status quos about or expectations about what a gross margins should be like for SaaS companies, for example. And so if you show me that, our margins are going to be 99%, we're going to be like, where's that coming from? And what is, either there's something really incredible about this, or the founder doesn't quite understand what's going on. And that just gives us a pause for concern. And then, one thing that we do at Spero that I'm not sure everyone does this, but I think it's a good exercise for you all to do, but also one that we always do, which is we, use a model and map it to a market sizing, right? So we do our own market sizing exercise to say, how many potential buyers in this market might there be, and how do we see that market growing over time? And then we kind of, we have a number of potential customers in XYZ vertical, and then we map that to your model. So you think, if we think that there's 100 potential customers in this market, and you say in order for you to get to $100 million business, you need to acquire 90 customers, then we'll stop there and say, is it feasible? Do we think this company can capture 90% of the market? Is that realistic? And can they do that in 9 years? So just mapping, mapping the feasibility of the business model and the number of customers that you're going to need to acquire, and how that maps to how big the market actually is. Great. So will I be held to the numbers that I share as a founder? Will my investors hold me to what I project in our diligence? The answer is no. Your business will and should change. I will say this is particularly true for the seed stage and more, and even also for Series A. As you go on into B and C, once you have a repeatable business, then absolutely, a lot of the investments made on the predictability of your business and what you're projecting. But in the seed stages, no, you're still finding product market fit, and half of product market fit is finding a business model that works in said market, and so your business model likely will change, and that's fine. So no, you shouldn't be held to it. And if you are, that goes back to what I was saying earlier about, maybe a red flag if an investor is spending that much time in your model at the seed stage. Okay. So hopefully that kind of set the context, dispelled a few myths. What's the point? Why do we use it? How do we use it? How do investors use it? How do I think founders can use it? But now we're at, where do I start? Again, I know for some folks it's there's nothing less intimidating or more intimidating than opening up a blank spreadsheet and kind of trying to create something from scratch. So where do I start? And hopefully we'll walk through kind of a pretty basic example here, but you always start with your assumptions. So those are your revenue and cost drivers. And we're going to do an exercise. So I'm going to start with a question. What are your key revenue drivers? So revenue, and I'll give you a second to think about this and write it down. But if revenue, and this is an oversimplification, there's many other ways to present this, but if revenue is a product of the number of customers you have and the price at which you sell your unit, or the price at which you're selling each thing you sell, right? So revenue is a product of customers times price. Let's start with the customers piece. Let's take a moment and just think about this. How do you acquire customers? What are the inputs that lead to your customer acquisition? Take 30 seconds, just write down, what are the inputs that lead to a customer acquisition? It might be Facebook ad spend. It might be a salesperson. It might be, just take a moment and think about what ultimately drives customer acquisition or growth. All right, so some of the more common answers that kind of feed into financial model would be, your sales headcount. So this is very common for SaaS companies. So you'd start with how many salespeople do you have in a year or in a month, or how often will you be adding a salesperson, plus the quota. So how many new customers do you expect that salesperson to add in a month? So that would sound like something like, for every one salesperson I have, I can expect them to acquire 2 to 3 customers per month. Similarly, some are very marketing driven, right? They know if I spend $25, I can acquire 1 customer on Facebook. Or some companies rely on distribution partners. For every university partner I can bring on, I can expect to get 400 new students signed up. Or in many, for marketplaces, for local marketplaces, it can be a market expansion thing. We are at a point where, I can predict that for every new market I enter, for every new city I enter, I can expect to acquire 1,000 new users. And this is not exhaustive. There's hundreds of other ways to think about this, but these are just some common answers. So I'm going to use this sales personnel headcount and sales quota just to show you how to kind of build your first, that first assumption step. So it's very simple, right? You're just building in this case, we're building projecting out 4 years. And this is just this is the beginning of an onion, right? Models kind of get more in depth over time, but we're going to start like the very high level, how you can start. And so, if you're a SaaS company that's driven by outside sales, right? People go out making calls, cold calling folks and getting them to buy your software, whatever it may be. I'm modeling out here that I think, in year 1, I'll have 1 sales rep. In year 2, I'll have 3. In year 3, I'll have 5. In year 4, I'll have 10. And I can expect in each of those years, the salespeople to do 2 in year 1, 2 in year 4. Acquire 2 customers per month in year 1, 2 customers per month in year 2, 4 in year 3, 4 in year 4. So basic place to start, you just put them into your cells. These blue cells denote that they're assumptions. So these are predictions that I'm making. These are going to be the pieces that move in the model. When I want to change the model and play around with the model, when it's a finished product, the blue cells are the things that I'm going to move around. These are my hypotheses. Okay. Now, if we're saying revenue, again, is a product of customers times price, you can think about, okay, how do you make money? Let's take, again, just answer these briefly, write them down, think about it in your head. How do you make money? What is your unit, and how much do you charge per unit sold? So for example, in a SaaS company, my unit is 1 license, right? So that might be per seat, or it might be per customer, but it's, for maybe a marketplace, your unit is, or maybe you're a direct consumer company, 1 unit is your Harry's razor that you're selling. If you're, I'll let you just take a moment and think about kind of what is your unit, and how much are you selling that unit for? All right, so some common answers, would be an annual subscription. So we're charging $99 a year for our software per company. Maybe it's a monthly subscription, again, common for enterprise and consumer SaaS. Maybe I'm a language app and I'm selling my language app for $15 a month, annual subscription, or Netflix, for example, $13 a month for their consumer subscription. Another common one for SaaS would be per user per seat. So we'll charge $9.99 for every person at your company that uses this. Maybe there's 100 users, ends up being, so you charge on the per seat basis. The take rate, so this is kind of in a different one, right? So this is how you make money in a marketplace. You're selling goods, services, whatever it may be, and you're taking a percentage of the volume that goes through it, or the percentage of revenue that goes through it. The order volume, so this is another one, marketplaces. So that's kind of how you make money, right? High number of goods, you're dependent on the number of products that are flowing through your marketplace, and advertising, so clicks, right? So that's another one, consumer social. But I'm going to stick with the SaaS example here. We're going to use a monthly subscription. So I'm adding kind of just another additional layer here, which is, the average monthly subscription. So maybe I have a tiered pricing, but I'm going to go with the average monthly subscription as my kind of initial unit here. So I'm selling my SaaS for $100 per month per customer. In year 2, I think I can get it up. In year 3 and 4, I can get it up and up. And when you have moments like this where something changes in your model and you want to add additional color, you can kind of front run the questions that you think an investor might ask, and you can add a comment into the spreadsheet. And just adding a little bit of color, right? So I think we can convert more of our sales to our premium tier at $199 per month, which would increase the average monthly subscription price from $100 to $150. Maybe 100% more on our $99 subscription, and we get it to 50-50 in year 2. And maybe in years 3 and 4, we introduce different pricing structures. And you can continue to add comments there. Okay. The last one that I didn't start with, but I think is really important, is that lifetime, right? So what are revenue is, what you want to capture with revenue is kind of the accumulating number of customers that you have over time. And you want to also show kind of how many customers are leaving, because that's an important metric that investors will ask about. So, just another one, how long do your customers stay around? How often are they purchasing items? Think about that for a second. So really like the only, answer is really is retention and churn, right? So, for a SaaS company, depending on where you're at, you should be tracking your churn or your retention numbers. And they're very kind of public data about what kind of retention numbers should be for different business models. But typical answers you'd hear is like our annual retention is 90% for SaaS. Our 6-month retention is 40% for consumer subscription, which is really strong. But the point is, when you model that out, you can show what you project to be kind of the annual retention rates, which will impact kind of your key revenue drivers over time. So in this case, you can kind of back into annual retention too. So if you ask yourself, how many years do I think a customer will stay around for? And if you say 5 years, there are equations out there. I encourage you to go check it out. But essentially, you can kind of back in and say, and just if you expect one customer to stay for 5 years, you can expect 20% of your customers to churn every year. So it's kind of a high level equation. You can check, just Google it real quick, like backing into retention or annual retention numbers through lifetime projections. Okay, so those are your revenue drivers. And again, I'm keeping this high level. All of these things can be peeled back incredibly. For example, if you have multiple pricing structures or multiple tiers, you can break this out by the tier of or the monthly subscription price and project kind of the number of customers that will have each subscription. So this is just kind of the beginning. And as you go over time and as you begin to kind of get more comfortable with your model and understanding your business model, you'll start to add layers to the assumptions, which will kind of add color and continue to show that you deeply understand how your model is going to move and change over time. So what are your key cost drivers? I'm going to keep a little bit more high level, but the common answers and the most important ones are, the cost of goods sold, and then three areas within the operating expenses. So, your customer acquisition, how much are you spending to acquire users, which would fall in the model as a sales and marketing section. Your personnel, which is really, your salaries, how much you're paying people, and then your general and administrative things. So your rent, your professional services. And again, this can get way more in detail. If any of you come from accounting backgrounds, you're probably rolling your eyes because this is an oversimplification of everything. But this is kind of how you can think about it when you're building that first rudimentary model. So again, you're making assumptions about how you're going to spend money over time, right? So you can kind of map these a little bit. So you think about your key cost centers. The first one being gross margin. So your cost of goods sold, how much are you spending for each dollar that you make in order to service that, the product that you're delivering. So if I'm selling razors, how much does it cost me to produce one razor, and what percentage of that is collected in revenue? So gross margin is just what percentage of the sell price do you actually collect, and then you can spend on kind of your operating expenses, right? So again, a lot of gross margins for your particular verticals are public, and there's a lot of best practices information on the internet that you can kind of find what is the expected gross margin for your type of business. So if you're a SaaS business, great SaaS businesses have gross margins from 70 to 90%. Some are even higher in some cases. I'm projecting that this company gets really good by year 4. And SaaS businesses are great because they usually have improving gross margins and solid gross margins to begin with. So then the sales and marketing, you can see here that I just mapped, I just modeled out kind of how much I expect to spend. I project to spend on my marketing each year. And I tie my salary per sales rep, which will be tied to the revenue drivers when we get down to the actual model in a moment here. And then the quota, right? So how are you actually, and the key here is to actually just take a step back and literally think about how are you paying your, where are you spending money? How are you spending money? And for everything that you spend money on right now, you can create a line item and start to make assumptions about. And there are different ways to do this, right? This one is very much built on forward-looking budgets, right? You thinking about just from your, just making hypothesis, doing research, talking to other founders, how much can you expect to spend based off of how you anticipate to grow? Where do you see yourself in 4 years? Are you going to be in a big office? Or are you still going to be in a WeWork or whatever it may be? This is one approach where you can kind of just model out. The other approach is, you can, without getting into too many nitty-gritty details, but you can make some of these assumptions to be percentages of the revenue that you collect. So if you're a SaaS business, again, there's a lot of public information about what the typical high-performing SaaS company will spend as a percentage of revenue on different things, right? So they can expect to spend 40% of revenue, 40 to 60% of revenue on sales and marketing efforts. They'll expect to spend 30% on R&D or engineering. They can expect to spend 8% on rent and so on and so forth. So that information is public, and I can follow up with a great place to check out, particularly for SaaS. Pacific Crest survey is one that has a lot of really great information. So the point being here is that there are different ways to approach this, and this is kind of one bottoms-up approach that we'll talk about that more in a moment. And then the personnel tab, I think for a seed stage, this is one that I think one place that I actually kind of encourage people to get into the weeds on and spend a little bit more time here projecting out how you expect to grow the team and what areas and kind of what's the progression of how that team will grow. And how really this is key, because this is where you're spending the money that you're going to raise, right? So really, I think that companies that have a special tab, a tab broken out for the personnel, breaking out how much they expect to pay for each employee, when they expect to start hire them, can be a really valuable tool in telling your story about how you think this company is going to grow. Because ultimately, the key inputs in how this company grows is the employees that you hire. So I would encourage you to build out a separate tab. And again, these are all kind of best, intuitive projections on how you see the company growing when you think you'll hire people. And we're kind of moving through this quickly, and I'm sure I'm not doing a perfect job of explaining everything, but just like that, we've built a really basic model. Using the assumptions that we made, we can start to kind of, with basic equations, start to fill out our model, right? So we mapped out how many sales reps we expect to have in year one, and how many new customers we think they'll be able to bring on in each month. So we have one salesperson bringing on 2 customers per month for the year. So we'll have 24 new customers. Churn customers is tied to our retention number up here, which was 80%. We don't have any customers from the year before, so none churn. They're all in year one. And then in year 2, we have 3 salespeople bringing in 24 customers a year, or 2 customers a month, times 3. So we have 72 new customers. We had an 80% churn rate off of this number, which is 4 customers. And we add the new customers from the total customers from last year minus the churn customers, and that's how many customers we have. Revenue is simply just the number of customers we had multiplied by the average monthly revenue, and then multiplying it by 12. The cost of goods sold is just using that gross margin assumption we made, 85%, taking 85% out of taking 15% out of our 166, our cost of goods sold is 24, and so on and so forth. You can see this is all very simply tied with a very basic with, very easy, nothing crazy, no like deep multi-function cell equations, right? It's just very easy, tied to our assumptions, mapping out how you see the company growing. Now, I will say there are two. I alluded to this earlier. There are two different financial model approaches: a bottoms up and a top down. What I just walked through was more of a bottoms up approach. So if I have this many resources, our outcome will be X, Y, and Z. So in this case, we said if we have this many salespeople, we'll grow this much. It's, in this case, the inputs that drive the model are our core assumptions, budgets that we have, and expectations on what we'll spend. And the output is revenue or growth. So it starts with the inputs, it starts with kind of resources, and ends with revenue or growth. The opposite of what you could do, or there's the other approach, which is a top-down approach, which is if I want to hit XYZ in revenue, we need this many resources. And so the input, instead of starting with salespeople, you start with the amount of growth that you want to have in a given year, whether it's year-over-year growth or it's revenue target. You start with, okay, I want to grow 300% this year, 200% in year 2, 300%, 200% in year 3, and 100% in year 4. And so what does that actually look like? This is how many customers that type of growth would look like. You can kind of work backwards based on, similarly making the assumptions about the quota per salesperson per year. You can work backwards to see how many customers you'll have to have in that given year to grow at the pace that you want to grow at, how many new customers that means you'll have to acquire. And then using this assumption on how many sales one rep can do in a month, you can work backwards to understand how many salespeople you'll have to hire. So the inverse is, the difference is, one is me sitting here saying, this is how many salespeople I think I can have, versus the other being, this is how many salespeople I'll need to have in order to get to this growth or target that I want to have. And so we can spend more time digging into that if you have questions at the end. But just know you're starting, one starts from the bottom, which is like the ground floor. This is how many salespeople we have. The other starts with the higher order, kind of this is the growth we're looking for. And just to say, one's not really better than the other. They're just kind of different ways of how you, the entrepreneur, think about kind of the business and how, what intuitively makes more sense for you as you're building this tool. Okay, so now, again, I said this is a tool. We've talked about it a bunch, but how do I actually use it? Once we've built it, how do I actually use it? Use it to test your assumptions. So we talked about, how many salespeople we think we can hire in XYZ years. What if we ramped up sales even higher? How many, what would that do to our revenue? What would that mean in terms of acquiring, or in terms of how much capital we'll have to raise? Play around with the different assumptions. What if we have to spend more on engineering than we think? What's that going to do? What if our what if we don't pay rent? What if we're a fully remote team? What would that do? Again, I talked about kind of using it in parallel with market sizing exercises, but I think that that's really important and really valuable. Making sure that your business is like actually viable, that there's a there there. Generally, I think it's a really great exercise for you and a forcing function for you to just visualize the key inputs and outputs of your business, and it can really help you prioritize where you need to be spending your time and focusing. And then I think a key one is, use this to help you understand how much capital you actually have to raise, right? So a lot of founders just go out and say they need to raise X, Y, and Z because that's next up in the, they need to raise a $2 million round, then an $8 million round, then a $20 million round, because that's just what we do, right? But the reality is you raise venture capital in order to grow to a certain point. And what you're doing with your model is mapping out how to go from here, from A to B, and the output, one of the outputs should be the amount of capital that you'll need to raise. So in this example, we built this model, we have negative net profits every year, but look, we've made we modeled out that we have a $1.5 million investment in year one and a $4 million investment in year two. And this is how much cash we have at the end of each year. So, we raise that 1.5 in year one, we spend 409 through year one, another 900 in year two. We're left with 173K at the end of the year, which is why we need to go out and raise more money in order to keep growing. So we raise 4 million and so on and so forth. So really a tool to help you better understand, that cash flow piece, like Brandon alluded to at the top of the call. And then again, it's a tool to tell your story. Use it as another tool in your toolbox to share your narrative. So just some key best practices. I encourage you to color code your cells. We talked about kind of blue being assumptions, black being kind of the outputs. So the things that are dependent on the assumptions. So, what is basically anything that's an equation should be black, and it shouldn't be, you shouldn't ever be changing those cells or like hard coding yourself. If you do hard code a cell, highlight it in red or some color or mark it just so people know. Sometimes you can't get around it. Sometimes you have to start a model with one hard coded cell. But make sure you make note of it. You can do it in red, you can do it in green, you can make a note of it, but I tend to do it in red just to really emphasize it. That leads into this next point. Avoid hard coding in the model as much as you can, outside of the assumptions, of course. The assumptions, really like in any given model, there should only be about like 20, at most 20 or 30 cells that should change and can change. And those are just like, me jumping in and playing around to see if I change the number of salespeople, how much will this grow? You shouldn't hard code numbers or formulas into the middle of the model, because it can break it really quickly, and then all of a sudden it's not a very useful or valuable tool. Make it as simple or as simple as you can, right? If it's complicated for you, it's going to be complicated for anyone who has to read it, right? In the same vein, I would say like avoid templates, right? These 2 points go together because at the end of the day, your model needs to be a reflection of how you see your business in your own brain, right? This is how you're, it's a tool for you, but also a tool to share with others about how you see your business and what are the key inputs and outputs. So avoid templates. No two businesses are the same. You're not going to be able to force your business into someone else's business. I think looking at templates is great from like an inspiration perspective, from a creative perspective, understand how other people are, building their models or thinking about their models, but don't try to force your business model or your business into someone else's template. And then the last one is just avoid ridiculous projections. Most unicorns don't even reach $100 million in revenue in 5 years. I know we ask for 5-year projections, and everyone wants to be a $100 million business, but the reality is very few do, and they are rarely, and the ones that do are rarely do it because they were so prescient enough to see this business evolve in the way it was going to, that many of them, it happens by luck. So point being here is like, model, just put realistic projections in. We're not going to hold you to it no matter what. They're not going to be right no matter what. But doing something crazy like saying you're going to grow from like 2 million to 40 million in 1 year is just not realistic. And it if anything, it just gives room for investors to ask questions and poke holes. It doesn't necessarily serve you well at the end of the day. Okay, that was long-winded and I hope useful. And I hope you all didn't fall asleep, because I know models can be not the most exciting topic, but with that, I will open up to questions. Brandon, are you helping me?
Yeah. So yeah, great chat, Stephen. Thank you so much for that. Sorry, I'm like, it wasn't like not there, Stephen. I'm like, just
Sure.
like wondering, so do you want to go through and like there's a few questions that are kind of residual from the chat here, right? So some of them, up front, like the first question was, do we need like how much modeling do we need when we're like in the pre-seed stage, right? Like in the very beginning, right? When you're maybe finishing up your product, or you've like just started building your product, or, you know, you're trying to get angel funding, right? Like what's the appropriate amount of like modeling and kind of revenue money conversation at that stage is some of the early sentiment. I guess if and then going on from that into like, you know, how do you project all the way to like market share? So just looking at the first two questions in chat kind of together.
Yeah, so I don't think it's required. I know many people at the seed and pre-seed and angel stage that didn't raise with a model. But I do think that I think it's nonetheless a valuable exercise for you individually. I also do think for first-time founders, particularly, like if I went out to raise an angel or pre-seed, having no founding experience myself, I would build a model and I would share it with my investors, because it would just be another opportunity for me to prove that I know what I'm talking about, and that I've thought this through, and that I have, you know, played around in my own head and proven to myself that there's a viable business here. Now, I don't think that the vast majority of pre-seed or angel investors will be asking for your models, but it doesn't hurt to have it, and it doesn't hurt to use it as an additional way to kind of share your story and tell your story. And then, you know, the second part of the question, which I guess is, how do you justify your assumptions, or how do you validate kind of your future projections? Is that right, Brandon?
Yeah, I mean, I think that's part of what the question was. And Alberto, you know, feel free if you want to ask a question or ask the question yourself. I can unmute. Let's see. Is Alberto? Yeah, Alberto, do you wanna ask your question?
Absolutely. Yeah. So I really, you know, a lot, especially at the pre-seed stage, you get a lot of, you know, a lot of questions about what assumptions you've made, and a lot of them, you know, when you do the TAM, SAM analysis, kind of like how, you know, a lot of the times you just have to make assumptions like, if I spend X marketing dollars, I expect to get X market share. And it's really, you know, do you find those kind of to be okay, credible in the early stages, or you should kind of stay away from those type of assumptions?
So the way that I think about, you know, mixing the market exercise with a financial model exercise is really just to, like, you know, so take a step back. Similarly with market sizing, you can do a top down market size, or you can do a bottoms up. I always encourage people, particularly in the early days, to do a bottoms up market size. I think it is also similarly a valuable exercise for founders, just to understand the market and how big it potentially is, and then how it ties into your business. And I think the two are like more linked than one could assume, right? And so the key point of doing the market sizing and then mapping to the financial model is to say, okay, if I think the market is this big, and in order for me to get to be a really large business, I'm going to have to acquire X amount of users based off of my business model. Does it seem rational that I can acquire that many users out of the market that I've just created, right? So I think no company really gets more than, no startup per se, or even one that goes public has more than maybe 10% of their market share, unless they are the company that has created the market. So if you're going to have to get to like 80, 50, 70, 80% of the market that you're trying to capture, then that just gives us red flags. One, either the market's not that big, or two, the business model, the way you're charging, there's some flaws there. I hope that answers your question. I think I would just also take a step back. Like, at the end of the day, this is all a sales game. So it's all, as much as, you know, it's all rooted in how much kind of selling and storytelling you can do in order to give me confidence and to believe what you're saying, right? So hopefully that's helpful.
Yeah, thank you.
Next question. I think Luciano asked a pretty good question. I can unmute Luciano. Let's see here. Luciano. Okay, Luciano, you're live. For your question.
Hi, yes, Stephen. Thank you very much for the overview. It's really good. Appreciate you taking the time to do that. My question's around, kind of the deterministic versus probabilistic modeling. I know you mentioned different approaches, top down, bottom up, but I think that's maybe another variation is, and it's related to the previous question. So we make assumptions and then we run calculations based on that assumption. Any thoughts on maybe a variation where rather than doing that, we just say, well, here is, let's say, a calculation based on the probability of an event occurring. So if I think I can, let's say, get charged this much in terms of pricing, or if I can get, and you kind of have different probabilities of being able to achieve that multiplied by some probability of getting some adoption rate over some amount of users. Any thoughts on maybe kind of that kind of expressing financials?
Yeah, my advice, I think, which I think gets at the same point of what you're trying to show, I guess, would be to do scenario analysis versus building it all into one kind of probabilistic approach, right? So say if you think that there are like 4 or 5 different ways, 4 or 5 different versions of the future that you could see happening, if I priced it at this price point and we had this many salespeople, or if I had a lower price point and we didn't have a sales team, or if I, was all outbound and it was marketing, you could basically build a model that has different scenarios built in which is just another layer on top of, which is more like a modeling skill set. But I would think about doing different cases or scenarios. So maybe oftentimes we see like a best case scenario, base case, or low end case scenario, right? And the best case, there's a drop down tab, and we can get all nerdy on Excel or Google Sheets if you want, but drop down tab that would change all the assumptions based off of what that one cell said. And there's plenty of material on out there to help you build that out if you're interested. But hopefully that answers your question. Cool.
Are there any other questions that people have? Brennan, we have time for 1 or 2 more. I guess no one really asked anything else. But
Brittany, do you have any questions for me? If you were a first-time founder, what would you?
Oh, saved by the bell. April asked one here. Let's
thank you.
Let's get April's question in. Here we go. April, I unmuted you to ask if you want.
Hi. Cool. Well, thanks for that, Stephen. It was awesome. Really good, really informative. I will just call out one thing that was super helpful was we created a financial model very early on, but what I've been doing when investors ask for it is not sending them the actual Excel spreadsheet. And I've been sending them, like a high level snippet. And I realized what you're saying is they would prefer to actually see all of these cells, correct? And the various inputs that we're putting in with comments and spreadsheets.
I would say it's fine to first send just the projections themselves, like a screenshot. But the further in diligence that you get, I would encourage you to send it and share it. The reality is that I don't know. I mean, more often than not at the pre-seed and angel, they won't be doing some sort of exit analysis, but at the seed and the series A and beyond, we'll either use your model to build our own model, or we'll build our own model from scratch. So if you share something that we can kind of work from, that's always helpful. I think maybe in your initial, in your deck and your initial collateral that you share, a screenshot's probably fine. And then if they follow up, having something really in detail. If you're really proud of it, if you really think it's an important piece of your story, I don't think there's an issue with sharing it immediately. But it's not necessarily something someone's going to ask right away. Does that make sense?
Yeah, super helpful. Thanks for that. And so that wasn't my actual question, sure, but appreciate that. So my question's not necessarily in relating to the model itself, sure, but we've spoken with several investors who, if our model does not show the 100 million in 5 years, that's a reason for them to say this isn't a venture capital play. So how do you really respond to that when we also know this side where it should be a very realistic model, but you're getting turned away for even investment opportunities if you don't show that right away?
Yeah. I mean, I have two dueling answers in that, and one is to say like have an investor facing model that just says here's what it would take. Here's on one end, showing what it would take for this company to become a $100 million business is a valuable insight for you and for the investor, right? Like, do we think it's realistic that they can grow this fast? And, is the market even big enough for them to get there in 5 years? On one end, I think it's like, I understand why some investors might think that. I think it's a bit short-sighted and not very nuanced and kind of lazy if that's really their answer for a seed stage company to say, if you can't get to 100 million in 5 years, then you're not a venture scale business, because the reality is that most large outcomes don't get to $100 million in 5 years. They get to 200 million in years 7 and 8, and it's because of compounding growth. So anyway, my short answer is, if you want to have an investor facing one that gets you to $100 million, then that's fine. But I think that maybe it's also like concerning if that's the response from the investor. So I'm kind of giving you a non-answer, but I'm trying to understand why the investors would think that way or share what those investors are thinking.
Yeah.
Does that make sense?
It's helpful. Yeah, it's helpful. It's validating in the direction that we've been going. So yeah.
Also just to kind of parrot that and add a bit is like, kind of an emphasis on unit economics. So if maybe if you're pre-seed or you're super early, maybe you're pre-custom, you have yet to make your first dollar, or even if you've only made a couple dollars, like kind of an emphasis on like, a transformation of your unit economics or like intended unit economics can also be powerful, because then it can kind of assuage the investor and say like, hey, like I know I'm just like, a person with a napkin and a PowerPoint here, but like I understand business in the fact of like, so at some point we have to like, make a profit off of every penny we drop in, right? And so kind of a fundamental point of like every customer, here's kind of like how's every dollar break down kind of mapping, and then building from there can also be useful in approaching what you just asked, because like, like, hey, if we build a good business from the start, then like the only thing, and you can see very clearly, realistically at the scale of one customer, how this business operates, then like the only other part of that equation is, are there enough customers, right? So it's like one customer gives us 50 cents on the dollar, and then you're like, and then all we need, at 1 million customers, that makes us, whatever, right? Like, and so that's the kind of argument that you can build from, to the point where even if the investor is like, just putting up a $400 million TAM bubble is like, that's what everyone does. But in a sense of building up from that point, it's like, look, like here's the TAM, but if you don't believe me, like here's the progression of what we're going for. Here's the market we're capitalizing on. And here's how that unit economic model changes at each like scale. So, as an experimental point, which is what you're doing is like seed or pre-seed, like you can kind of make that argument and rehome the conversation back to like, this is like a first check. This is like an early investment. We're not a Series C conversation right now, like, or a Series B, Series C, Series D conversation. Right? We're still talking pre-seed, early days. Like, let's talk fundamentals, and then like these fundamentals will lead us to a bigger, brighter future, right? So that kind of emphasis can help you divert back to what's important and kind of go away from the short-sightedness, if that makes sense.
Yeah, definitely.
Yeah.
I will say, I would add, Brandon makes a good point too. I know we're coming up on a minute here, but like another very key output, which I feel I kind of blew over here, is just that unit economics. Unit economics are an incredibly valuable place to have a conversation, particularly in the early days, making sure that you understand your customer acquisition costs and your LTVs and how that can map to your model. Those can be great places to start. If you have a firm understanding of those numbers too, that can be a really great place to start as you're thinking about your assumptions in your core model. And that could be a whole nother session. We could talk about unit economics, but I know we're coming up on time here. I just want to thank you all for participating and joining. I know this is like maybe not the easiest presentation to go through one-to-many, but hopefully there was some valuable nuggets in there. We will be sharing we'll have the recording and the deck we can share out. And I'm happy to share like the basic model that I worked out of to build those slides, if it's useful. And then, we can also follow up with a few more resources as well that I alluded to throughout the presentation. Thank you all again for your time. And I think this is our last session in the overall fundraising series that we've been putting on. So I don't know if Ha's still online, wants to say any final words, but it looks like she had to drop off. Oh no, she had to drop off for another presentation she's giving. So I just want to thank everyone again, and best of luck in this next step of your journey. And please don't hesitate to reach out to the Spero team when the timing's right, or if there's ever anything we can do to support your work.
Second that. Thank you, everybody. Have a wonderful day.